Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for April 4th of 2022. Please see our disclaimer for important information. We're back to looking at our weekly high-frequency data courtesy of our friends at First Trust up in Chicago. Obviously, with inflation bearing down on us, some of the consumer-oriented areas are softening up just a little bit. As we can see in the week-over-week column on the far right, we had a little bit of softness in hotel occupancy, although it remains fairly strong for the month. Open table was up. We've got some charts later in the pack kind of talking about a couple of these key areas. A TSA checkpoint data, strong for the month, soft for the week. Supply of motor gasoline. We're seeing a little bit of softness there, not too surprisingly, because the cost of gasoline is moving higher. Labor market, we had a really strong report this past week, and obviously the labor market continues to be extremely tight. Some of the industrial areas, we do see steel production off in the week and for the month, and you can see that most of those categories towards the bottom half of that table are still tracking below their 2019 levels, although as we've been talking about over the last month or two, that those gaps have largely been narrowing here, and right now we really don't have an issue with regard to the coronavirus. The big bear on the back right now, so to speak, is inflation. And where is that going to take us in terms of consumer spending? We've got some charts on consumer spending versus real consumer spending and what the effect of inflation is doing. We've got some charts on disposable income. We can see what that's doing. But you can see here a little bit of softness in the last week related to some of the inflation impacted areas. Here's our personal consumption expenditures data on the left-hand side, and then you've got the core PCE is what it's called, which is less food and energy, which obviously we know are exceptionally volatile right now. And so you can see the dramatic rise in terms of the year-over-year changes, really beginning towards the beginning of last year and continuing to accelerate as we enter the second quarter now. So you can see that both on the price index and then also on the core, not moving up necessarily as fast, but certainly moving in a direction that is unwanted now, and something that's clearly going to be on the conscience of policymakers as well as, frankly, consumers heading into the summer. Right-hand side, you see personal consumption expenditures. This is the spending side of it. So you can see here on the red line, that is the all-in nominal number. You can see the impact of the pandemic and the associated bounce back. But then you see where it's just kind of flagging to maybe slightly up. So personal consumption expenditures and consumption overall is still moving higher. The problem is you look at those bars, and that's essentially real PCE. That's real expenditures. And obviously you see the impact of inflation creating that increasing gap between those two. All right, well, here is the real 10-year yield, and you can see that it's still negative, and it's moved a little bit higher from where it had been, but it's still definitely negative. And when you want to talk about, health of your economy, you really look at the real 10-year yield. And this is as of Friday. And obviously you want to see that real yield begin to move up, but you want to see it move up because maybe if interest rates move higher, inflation abates a little bit, and so you can have a positive real yield. But obviously we've got some heavy lifting to get to that point on a policy standpoint to drive down inflation where we are. And we know that we're going to have grain prices, energy prices that are probably going to be sustainably higher for a little while. We'll talk about grains and some of the commodities here in a second, but you can see here kind of a stubborn real 10-year yield. We want that to move higher. Excuse me. Here we have basically what we'll call Permanent job losses versus number of unemployed. So this is, both temporary and systemically unemployed. Good news is, again, on the labor side, people are able to find jobs. There's still essentially 1.7 jobs available for every unemployed worker. So there is still a gap of sorts, but you can see that we've retraced some of these levels back to the pre-pandemic levels in terms of overall unemployment and temporarily and displaced workers. Here's a quick look as we enter the discussion of yields. The 2-year government bond yield. Again, I mentioned some of this last week that we've actually had the market do a lot of the Fed's job for it. So obviously the near term overnight and 1 month rates are largely dictated by Federal Reserve overnight and federal funds rate policy. But when you get out a little bit past that 1 to 2 years, then the market's going to tell you what it thinks rates should be. And it is reflective of some of the Fed rhetoric. It is reflective of some of the what we call the dot plots on what the Federal Reserve Board governors, and especially those who are voting, feel like interest rates are going to be. And so you can see here that the 2-year yield, even if short-term rates are still, like overnight rates are still kind of like basically 1/4%, which is the current Fed funds target, that looking out 2 years, that number is almost 2.5% or 10 times that. And we've seen a pretty dramatic rise in that in a relatively short period of time. In fact, it's really almost unprecedented how quickly we've had a rise in that rate. Again, it's just reflecting what the environment is, but it's also steepening that part of the yield curve in the short end to help the Fed maybe achieve its policy aims a little bit faster. Well, and the flip side of this is what happens at the longer end of the curve, and there's still a lot of skepticism on there. I've got 2 charts in here, and this is a kind of a little bit busy because there are 2 different data series. The first one on the left is essentially the 2 to 10-year spread. It's basically taking the 10-year Treasury yield and it's subtracting out the 2-year Treasury yield, and right now that's ever so slightly negative. So basically what that means is on the 2 to 10s basis, we have an inverted yield curve. And then on the chart on the right, you actually have the 2 to 30-year spread. So the 30-year Treasury minus the 2-year, and that too has gone briefly negative. Now, of course, there is a long-standing axiom that once you see an inverted yield curve, that you or should expect a recession on the horizon. Now, the big question is, when does that recession come? And I don't think anybody in the finance world is under the illusion that we're never going to have another recession and that recessions are bad. They're just inherently, inflection points in the cyclical nature of our economy. And they happen from time to time. The Fed's got a tough job to try to raise interest rates to combat inflation and hopefully do it in a way that it doesn't choke off the economy. Considering that there's a global war, there's supply chain issues, there's also going to be an agricultural commodity and energy commodity related crunch tied to Russia and the sanctions and et cetera, et cetera. So, essentially what we have now is an environment we don't see too often. And we've had one kind of false inflection point where the 2 to 10 year spread did go negative back in the middle of last decade, and we didn't have a recession. But again, the notion of when a recession comes is widely up for debate, and the conventional wisdom and the data supports this is that it could take anywhere between 8-9 months and 2 years to develop. And so I think there's a lot of interest in what the economy is going to look like in 2023 and into 2024, because if history holds, then that's when you see some of maybe the outer linings of potential recession. And again, recessions can be very brief. Average recession is perhaps maybe 11 months, and the last one that we had was measured in, frankly, a matter of days. But again, it's not imminent. It's not literally on our doorstep. There are a lot of things that are still working, but we just, are beginning to anticipate and watch the data for clues as to when that might be. Here's average hourly earnings from the Bureau of Labor Statistics, the BLS, and you can see that average hourly earnings, again, a testament to the strength of the labor economy. Now, of course, employers are bearing the costs of these increased wages, but from a worker standpoint, from the health of the worker, from the health of the consumer, this is a good sign, especially at a time where, inflation is high. And so, real personal incomes are undoubtedly challenged, and so it's going to take some time for wages to really get up to pace with inflation, but it certainly will inflect at some point. We're just watching aggregate wages move higher, and that's actually a good thing for the time being. Here's the S&P 500 dividend yield less the 10-year treasury. So this is basically the yield on stocks minus the yield on bonds. And if you can imagine, in a normal rate environment, interest rates on 10-year bonds are going to be higher than the yield on the S&P 500, which, on average is anywhere between, 1 to 3%, depending on what the market looks like. And in a perfect world where we had equilibrium in the bond market, a bond 10-year treasury rate could be somewhere in the 4 to 6. So you typically see this be negative, and you can see as we go back to 2010 that it quite often has, except for notably the pandemic, and we had a time where in the taper tantrum in 2013, where 2012, 2013, where it wasn't, and then again in 2016. But generally it's negative, and we're beginning to see that trend in negative again, really for a couple of reasons. One, the equity market, even though with the corrections and the volatility that we've seen, is still probably within 5 to 7% of its all-time high. And also the fact that you've got a little bit of upward pressure on that 10-year yield right now. But we're going to continue to see that move lower in this time series. Quick look in here on something in the Financial Times I thought was interesting. It was tweeted by Liz Ann Saunders at Schwab. A lot of speculation as to whether there's going to be some crowding out of the dollar as the reserve currency of the world. You can see the bulk of that bottom shaded area represents US dollars as the reserve currency. And so if you look back to 1998, where it was about 70%, now we're about 60%. We still have a long ways to go before the renminbi makes a real strong play here. And I think during turbulent times, and if they persist to the extent that they persist into 2023, I think only strengthens the dollar as the reserve currency. But thought this was interesting to share. All right, from Husband Strategic Advisors, this one requires a little bit of explanation. So if you look at the blue line in this chart, again, you can tell there's a pretty strong relationship here. It's really interesting. So in the blue line, you have equities as a percent of financial assets on the left-hand scale. And so it's actually a decline. It's an inverted line. So when that blue line moves up, that means that equities as a percent of financial assets is going down. And so while that was happening in the 70s and remained low during most of the 80s, subsequent 12-year S&P 500 average returns were actually relatively good. So if you looked ahead, like in say 1970, of course, there were big chunks of time where the equity markets didn't do anything. But when you got into the 80s and the 90s, obviously you saw stronger equity market performance over a subsequent 12-year period. Well, that jockeyed around, and things changed a little bit. We had over time, particularly over the last decade, we've had a real strong influence of individual investors owning stocks. Equities, a percent of household assets, has continued to move higher. So what that tells you, if you believe this chart, is actually that the subsequent 12-year S&P 500 annual total return might not be as strong, which understandably is exactly what we've been saying. We've had some really strong years in the equity market. Feel like going forward that equity market returns are likely to be much more in line with historical averages, maybe even a little bit lower than that, but still positive. And in this chart, I think what this relationship does is actually confirm that belief. Here's another look at stocks as a percent of household financial assets, and you can see this kind of broken out in a scale that I think most people will understand a little bit better. It's not inverted like that last one was. So you can see here, during the 80s, we did see that decline. You saw that in that last chart, but then it picked up, and certainly in our tech bubble, everybody wanted to be in pets.com. A lot of money flows, and then it cratered when we went into a recession, and it's bounced around a little bit. And obviously, the global financial crisis put a wedge in that. But then it's picked back up, and it's actually remained really, really strong. In fact, as strong a period as we've seen since the end of last century. Here's a quick look at house price ratios, total price to income, and so. You look at this as a proxy for housing affordability. You can certainly see that it's becoming tougher because prices are moving up relative to income, and it's crowding out particularly the new home buyer. And we do see that in the data where the percent of new home buyers relative to the total number of home purchases is going down. So this is clearly something that I think could eventually bring a little bit more, I won't call it equilibrium necessary, but a little bit more balance into the home price appreciation that we've seen over the last few years. Here's real disposable personal income. Now, when you look at it on a nominal basis, when you don't, build in the impact of inflation, you see that number really kind of trending, hugging a lot closer to its longer term trend line that you can see there depicted in blue. But the impact of inflation is basically turning that data point into a negative trend. Now, even though incomes are going up, they're not going up net of inflation. So real purchasing power on the part of the consumer is going down. And so that's obviously not something that we want to see happen for a long period of time, but this is really the state of things right now until inflation can get a little bit more under control. And this is a lot of what the Fed is wrestling with because personal consumption that's driven off of this income number, it represents almost 70% of the economy. So, and when you look at the U.S. as 20% of the global economy, you can see that the U.S. consumer accounts for about 15% of the global economy there. And, it's really important to turn these numbers back around. And here's personal consumption expenditures. And we'll look at this in two veins here. Again, recalling the last slide was personal income. And this is PCE. This is personal consumption expenditures. We saw this chart earlier in the presentation, but I wanted to map it against real consumption. And so nominal consumption, you can see trending above the line. Over on the right-hand side, you can see it hugging to slightly below the line on a real basis. And that is the challenge for this economy because, if you have inflationary pressures, which are inspiring people to maybe accelerate prices, feeling like the prices are going to be higher in the future, then that has an effect. Or if people are just simply delaying purchasing now because they feel prices are too high and they're not willing to jump in, then that's going to choke things off. And in many cases, when they feel like their consumption power has gone down, consumers tend to, do different things than they would have, if that weren't the case. Here's a quick look at real consumer spending. So, and we've seen this data a couple of times here today, but I actually thought that this was pretty relevant because it breaks it out into the different components. So, and the real important thing is we've been watching the services spending number be pretty weak and lagging consumption of goods. Goods consumption has been really strong post-pandemic. Services has lagged, but we finally have gotten back to pre-pandemic levels, as you can see in that pink line. Here's personal savings rate. And so as consumption has picked up and we've kind of exited the pandemic phase, if you will, you can see that personal savings rate has dropped. And obviously we've exited the period of transfer payments from the large transfer payments from the government. I think transfer payments still accounts overall, if you count Social Security and whatnot, about 18% of total personal income. But nevertheless, here you see the personal savings rate has dropped back down to where it was before the pandemic. Now we get into S&P 500, you can see the sector returns on the left-hand side looking at the 1 month. So, with the backdrop of the Ukrainian war, et cetera, you see materials, real estate, energy, utilities have all outperformed the S&P 500. Consumer discretionary, oddly enough, has actually done reasonably well, but then you see the laggards are industrials, technology, financials, and consumer staples. On the right-hand side, you see kind of the factor returns. And so growth and minimum volatility has outperformed, whereas value has lagged, and quality has lagged too, which has been really interesting. So that's a little bit odd. You don't typically see that when you have times like this. So you typically see quality perform a lot better. Small caps have obviously underperformed, but there's a real inherent value there. It's just going to be a little bit tougher and maybe take a little bit longer to realize that, but it's still a viable part of a portfolio. Here's a quick look at return attribution. And focus on the far right, which is 2022 year to date. You can see last year, as you attribute the returns, obviously it was a huge year in the market. You see that most of that was driven by earnings, 12-month EPS, earnings per share consensus. That moved considerably higher. Companies were kind of exiting the pandemic shutdowns and whatnot, and so earnings year over year were really strong, and it propelled the market. We did see a little bit of erosion in the price to earnings multiple last year, but it really was inconsequential because earnings were so high. Well, the multiple compression, I should say, actually continued this year. I think in a very healthy way. We've seen several multiple points of contraction. Even as earnings continue to move higher this year, they're just not likely to move very high. Like year to date, I mean, we've got about 5% earnings increase implied in the market. We were expecting anywhere between 5 and 9% for the whole year. So we're kind of on track there, but we've seen some multiple contraction that's brought the equity markets down overall. But again, I think that from a value standpoint, markets are much better in terms of their valuation than they were, even if we anticipate a slightly slower earnings market. Now we switch our attention to what's going on in the fixed income market, and so that's been a tougher deal. Now, anything that has longer maturities or what we call duration, which is a calculated measure of risk, price risk for bonds, anything with a longer duration or maturity is really taking it on the chin. You can see at the very bottom, the 7 to 10 year U.S. Treasury has witnessed the most erosion. So when we say we're trying to manage our fixed income exposure, what I mean is we're trying to manage around that price risk. And so you can see that business development companies and oddly enough, emerging market high yield bonds have done relatively well in this environment, but also leverage loans and have also done well, and investment grade corporates have also lagged. Most of those are, a little bit longer maturities, and so they've been impacted. And this is why it's really careful to tread in fixed income right now, and you want to stay really short term in your focus, and you actually want pretty reasonable quality as well. Interestingly enough, as we look at the lending market, the credit markets, so at a time where credit is becoming a little bit more expensive, you see that loan balances in three different important categories. We've got large banks, total loans and leases moving higher. We've got consumer loans also moving higher, which is, again, very interesting here. The demand for credit remains fairly strong. Now, on the commercial and industrial side, we saw a huge spike during the pandemic phase as a lot of companies refinanced into into lower interest rates. And a lot of them kind of took on debt and lines of credit that they didn't necessarily need just to kind of secure their financial future. And so that's lagged a little bit, but interesting to see that credit continues to expand here at an age, a time where we're entering a new credit tightening cycle. We've got a survey of small businesses. So this is from MetLife and the U.S. Chamber of Commerce, and it's their small business index. I thought this was really interesting amidst the backdrop of all these headlines about what's going on or what could happen or, the sky's falling, whatnot. You can see here, on the left-hand side, we'll take these sequentially. How would you rate the health of your business? So you look at that green line, very good. Well, it's spiked up. And if you look at very good or somewhat good, that blue line, pretty high marks there. And when you look at, somewhat poor, which is kind of flat, but very poor, it's actually gone down. So, oddly enough, small firms have been, as this caption says, relatively upbeat about their business. Middle chart there shows you looking ahead 1 year, what do you expect your revenues to do? And you can see that green line moving higher, increase, and the decrease line is moving down. So again, optimism. And on the right-hand side, how would you rate the overall health of the U.S. economy? Well, there you can see that somewhat poor or poor, those lines are moving higher. So it's interesting that the small business view of the national backdrop is not so optimistic, but the view of their own business and their own operating environment is actually pretty strong. A couple of quick hitters here on high frequency hotel occupancy. As I mentioned, the data's been a little noisy, but overall moving higher, very positive. Airline sales survey, we didn't really talk about that much in our first chart, but about TSA checkpoint data. And we see here the airline sales survey remains relatively strong. We talked about this earlier, housing affordability. We saw that the prices to income moving much higher as of late. And you can see here, as is manifested in housing affordability in this index from Bank of America, you can see that number is moving down, and the impact from rising mortgage rates has a lot to do with the near-term data. And you can also see in that amber line, existing home sales are tracking down too. I just think, as I mentioned before, and to kind of reiterate here, that that this is going to, we always said last year, we were talking about these huge price increase numbers nationally for home prices, that once credit began to tighten, you're going to see some of the froth come off this. Now, I'm not saying that prices are going to outright go down, but I'm just saying that the rate of gain is inherently slowing because you can see the existing home sales data. People are getting pinched. There's still a demand for housing, and we're still battling our way out of kind of a 10-year deficit, if you will, of not having built enough homes, and we're still struggling to catch up. So there's definitely demand drivers, but housing affordability and tighter credit on mortgage credit, we see 30-year fixed rates moving closer to 4.5% now, and that's definitely going to have an impact here, I think. Well, and the last thing I want to talk about here is obviously food insecurities, food prices. You basically have Russia, which is the largest wheat exporter, invading Ukraine, which is the fourth largest wheat exporter in the world, and most of their primary export markets are, quite frankly, in the Middle East. And so when you look back on the Arab Spring, let's dial back to 2013, 2012. Back then, food prices were a big driver of that. And it was a time where Russia was in a major drought, and so Russia curtailed exports, saved more of its domestic production for its own use, and shut off, a lot of the Middle Eastern countries. And so, as you can see in the bottom half of this, prices really went up there. And I think the situation, as I've read from actually from Peter Zion, who had a really neat piece on this here this weekend, is basically saying the same thing, that this is going to be worse because you've got, basically, Russia attacking. Now they're shifting tactics, and they're not going for Kyiv, they're going for Odessa, they're going for their port cities, which are their exports, and they're also practicing kind of a scorched earth policy, which means that they're just basically trying to destroy everything, every productive capability Ukraine has, and that includes its agricultural sector. And if you don't have logistics, you don't have ports to export, you're basically taking the fourth largest export market for wheat and basically shutting it off. And so if that's the case, then you're going to see probably a renewed level of pretty significant population unrest in these red areas. And you're going to see a lot more stress and food insecurities here over the next couple of years. Well, that's all I got this week. I hope you've enjoyed the broadcast, and behalf of the entire team at BKA, we hope you have a wonderful week, and we'll talk to you again soon. Take care. Bye.